And while that's a little bit more streamlined, but if you have a lot of people that are working at more than 20 hours per week or more than 50% capacity, just shortcutting it and giving yourself 0.5 might be, low ball on the FTE number when it comes to this. So that's kind of a pro and con that you got to weigh. And just like the salaries and wages, there is a safe harbor to catch up to FTEs. So your loan forgiveness, if you reduce the amount of FTEs, you won't get docked for that if two things happen. One is an employer, they terminated employees between February 15th and April 26th of this year. And second, and again, old rules say as if by June 30th, 2020, the borrower restores their FTE headcount to the February 15th level. So again, two safe harbors that are out there. If you reduce salaries and wages, and if you cut FTEs. And as we covered, last time, I'll be perfectly honest with you and straight up, this is not as easy when you do the actual PPP loan forgiveness, application, but this is kind of a streamlined calculation on effectively how this is going to work. So what would happen is step one, you take the payroll and non-payroll costs that we just covered. So non-payroll, again, that's your rent, utilities, mortgage interest. So you look at what you paid during the covered period. Then step two, you reduce any payroll, any non-payroll costs, that were cut, by salary and wage reductions. And again, this is assuming there's no safe harbor. So then after you cut your payroll and non-payroll costs by the salary and wage reductions, then what you do is you multiply it, step two, by the FTE reduction percentage. So in our previous example that we covered, we said we went from 100 FTEs to 80, so that's 80%. So you take step two, you multiply it by 80%, that gives you what's known as your modified total. And then if you go to the last step, step four, your loan forgiveness is the lesser of one of three items. That modified total that we calculated in step three, or the actual PPP loan, or the payroll cost divided by 0.75. So that was an overview of, really, how the PPP loan forgiveness worked under the old rules. But then what happened, a few weeks ago, the Paycheck Protection Flexibility Act of 2020 came into play. And really what brought this to life is there were business owners in certain industries where they were really up in arms. And to name a few industries, restaurants, hotels, retail, as an example, where they were very concerned that the 8 weeks was not going to be enough time to spend the PPP money. It wasn't going to be enough time to bring people back to work. It was also a concern where they would have a tough time making up the salary and hourly wage reductions. And also the 75-25 split between payroll and non-payroll costs seemed very rigid. So what the government did was they came in and they passed this act where now there's some flexibility on some of these items, and we're going to go through that. So the Paycheck Protection Flexibility Act, it was signed into law on June 5th, and we're going to give you a summary of really what this entailed. The first thing, and this is a big change that came from it, is the cover period got switched from 8 weeks to 24 weeks, and that's a big change. And now the one thing I will caveat is that you still have the opportunity to use the 8-week period. So there's still going to be business owners out there where the 8 weeks is still going to make sense. They'll be able to make all the metrics work with regards to the loan forgiveness. So you still have the option of using the 8-week period versus the 24-week period. I will say, however, that, and I've had this question come up a lot in the last couple of weeks, you can't choose anything in between. You can't say, I want 10 weeks, I want 12 weeks or 16 weeks. It's 8 versus 24, and that's a big gap between those two numbers. So that's a big decision that's going to have to be made. The second item that came from this is the safe harbor date to restore salaries, to restore FTEs. That got changed from June 30th to December 31st. So you have up until December 31st to bring things back to where they were on February 15th. Now, one qualifying statement I will make, there's still potential that if you go with the 8-week period, the government could still say, well, your safe harbor date to make things whole is June 30th, but we think it's unlikely they're going to do that. We believe it's going to be December 31st for everybody as your safe harbor date, whether you go with 8 weeks or 24 weeks. Another big change that came of this is the mandatory payroll spending percentage decreased from 75 to 60. So now you can spend up to 40% of the PPP money on rent, utilities, and mortgage interest. So that added a lot of flexibility. And that 60-40 split between payroll and non-payroll costs is for everybody, whether you go with 8 weeks or 24 weeks for your covered period. Other items, the loan maturity date went from 2 years to 5 years. And now I will say, however, the 5-year loan maturity, that's only applicable at the moment for loans that were issued after the act was passed. So any PPP loans that got issued after June 5th would have a 5-year duration. everybody before that is still at 2 years. However, there's a good likelihood that they may turn around and say later, all right, 5-year maturity for everybody. So that's a planning point to think about if there's a chance that if the PPP loan is not going to qualify for full loan forgiveness. And the last bullet point, and this is going to give a lot of time to really think things through, and I think this is a game changer, and this was something that there was no clarity on before this act was passed, is you have 10 months to apply for the loan forgiveness from the last day of the covered period. So what this will do is if the 24-week period goes up until the end of the year, you could really drag out applying for the loan forgiveness until September, October of next year. So that's going to give a lot of flexibility. Now, as far as the reductions go, this did not change. The salary and wage reduction rules still apply. You got to look at your payroll costs, and you got to back out anybody that got a 25% or more haircut, on their compensation. So that did not change. The safe harbor is still applicable for anybody that had salary or wage reductions. You can make everybody come whole. The only difference is that instead of June 30th, you have until December 31st to bring your employees, salary and hourly wage levels back to February 15th. FTE piece is still the same. The rules are exactly the same. The only difference is you look at the FTEs on either the 8-week period or the 24-week period, contingent upon what you decide to use. You still have the 3 options to pick from as your baseline. And then the safe harbor thing is exactly the same. The only difference is like the wage reductions, you have now until the end of the year to bring your FTE count back to where it was on February 15th. And then the PPP loan forgiveness calculation still relatively the same. The only difference from the old rules is that if you go down to step 4, loan forgiveness is the lesser 3 items. It's still modified total. You still have the choice of the PPP loan, but the difference is on payroll costs, you now divide that by 0.6 instead of 0.75 because there's a minimum of 60% of the PPP money that's got to go towards payroll costs. So all in all, it was not a lot of changes, but as you can see, some of the changes that came out were pretty significant and will be a game changer when it comes to this. And there's some other various items that came with the loan forgiveness. Payroll costs, the rule of thumb with payroll costs, it's got to be what's paid or incurred during the 8 or 24-week period. When this thing first came out the first time back in late March, we initially thought that it had to be paid and incurred, and that just didn't seem practical because a lot of times when you pay payroll, you're usually paying it for, a couple weeks prior to, what was accrued. So you might issue a payroll on April 15th, but it might have been for work that was done in early April, even late March as an example. Payroll costs incurred during the last pay period of the covered period may be considered paid if it's paid after the 8 or 24-week period. So, the general rule of thumb I would recommend with the payroll costs, as we shared last time, is that, assuming most people are on a bi-monthly or bi-weekly payroll, I would basically assume that you get 4 payrolls in, if you go with 8 weeks, or if you go with 24 weeks, it's going to be 12 payrolls, generally speaking. And then for each individual employee, this is what's a little different. Previously, if you go with the 8-week period, there's a compensation ceiling of $15,385 per individual employee. But if you go 24 weeks, that cap is now $46,154. And what these numbers represent, it's $100,000 maximum compensation that was eligible for PPP funding, prorated for 8 weeks or prorated for 24 weeks. Same as last time, you still have what's known as the alternate payroll cover period, where effectively, if you're on a bi-weekly or more frequent payroll schedule, you can start the 8 or 24-week timer for payroll only on the first day of the first pay period following the loan disbursement. So as an example, if you get your PPP loan on April 15th, and then a couple days later you turn around and pay payroll, you can start the payroll timer, say April 18th or April 19th, as an example. And again, only for payroll. You can't do this for the non-payroll items. Owner compensation payouts, a couple of minor changes on this. Any amounts paid to owner employees, anyone that's self-employed or partners during the 8-week period, it's capped at the lesser of $15,385 or the 8-week equivalent of 2019's compensation. And this rule was in here because they didn't want owners who had, lower salaries or no compensation last year to effectively give themselves a raise effectively to, make the loan forgiveness work. So they don't want people gaming the system. And then for owners that have a 24-week period, this is what's interesting is for a 24-week period, the maximum compensation for an owner is the lesser of $20,833 or the 2.5-month equivalent of applicable compensation. So that $46,000 ceiling that we just covered for regular employees is not the same for an owners. Owners have that $20,000 cap. And what's different about owners, this is still applicable from last time compared to regular employees. You can't include health insurance, you can't include retirement benefits for owners in forgivable payroll costs. Payments to furlough employees, bonuses, hazard pay, those count as well for payroll costs. On the FTE piece, this is still the same from last time. Any FTEs that are offered the opportunity to be rehired and they decline for whatever reason, you won't get dinged on the FTE reduction, but this is only if you can't fill this position. So if you offer a handful of people their jobs back and they say no thank you, and if you bring somebody back to fill their roles, that doesn't count. That's basically only if you can't fill their spot. And the FTE figure also will not be reduced by any employee that's fired for cause, voluntarily resigns, or they voluntarily request a schedule reduction. And we covered this last time, and I think this is good they have this because, there was a lot of concern that employers would be handcuffed if somebody walks off the job, no fault of their own, or if somebody is fired because they did wrong and there is cause, because there was concern that why am I going to keep somebody on payroll that clearly, did wrong, and if I'm just doing it just to make the loan forgiveness work, it's just not practical from a business perspective. So that's a good thing that's in there. And employers won't be double penalized as last time if there's both a salary and an FTE reduction in employees' hours. So an example, if you have a business where there's a lot of hourly employees, if the hours are not there and the employee doesn't come to work, you obviously can't pay them, so you won't get whacked on both reduction calculations. We believe it's just going to be the FTE reduction that you'll get penalized on. Self-employed individuals and sole proprietors. This was very eye-opening when this came out. Now, when a sole proprietor or a self-employed person, when they apply for the PPP loan, as we covered near the beginning, it's 2.5 months of 2019 self-employed earnings is what drives the PPP loan. But the loan forgiveness, what's interesting about this is if someone that's self-employed that elects an 8-week period, the loan forgiveness is going to equal 8 weeks of 2019 self-employed earnings because that's the presumptive salary that the self-employed person is paying them themselves. No ifs, ands, or buts. And that's basically going to equal about 73% approximately of the PPP loan. But what's interesting is that if you go with a 24-week period, the loan forgiveness equals 2.5 months of the 2019 earnings, which is effectively, that's what the balance of the PPP loan is. So if someone that's self-employed that goes with a 24-week period, we believe that it would be 100% loan forgiveness. And then you're done with it effectively. So that's a very good planning point for self-employed folks. As I mentioned at the beginning, is that you now have 10 months to apply for the PPP loan forgiveness. So if this is, if you're self-employed, strongly consider, not rushing the PPP loan forgiveness and rather just going for the 24 weeks. And it should work out where you get 100% loan forgiveness. Non-payroll costs, no changes with these areas. You're still eligible for loan forgiveness if it's paid during the covered period or incurred during the covered period and paid on or before the next regular billing date. So basically what this means is that if you're on an 8-week period, you basically get to pay 2 months of rent, utilities, mortgage interest. As I mentioned on the next bullet point, you can't prepay anything. And if you go with the 24-week period, that's just under 6 months. So you basically get to accrue 6 months and pay 6 months of those items. And just a few various points, PPP loan forgiveness is reduced by any economic injury disaster loan advances that are received. And the intent behind this is the government doesn't want you, doubling up any benefits, because when you get a disaster loan advance, that's a prepayment of your loan. That's a free benefit. You don't have to repay that. So if you get that advance, that comes out of the loan forgiveness. And on a side note, I know we're covering the PPP loan forgiveness, but the EIDL did reopen a couple weeks ago, and they are accepting applications again. So if you need more money in addition to the PPP, the EIDL is back on the table. Now, this is still applicable from last time. If you have a PPP and an EIDL, you got to use it for different purposes. So for instance, the PPP loan, the primary purpose is payroll, rent, utilities, mortgage interest. You can't turn around and use the EIDL for those same items. You got to use it for something else. And you can't use PPP money to fund wages that are covered by the Families First Corona Response Act. And what that is that there was an act that was in place to give employers tax credit incentives for paying people that are out sick because of coronavirus, or they can't come to work because they're home, caring for their family that's either sick, or kids that can't go to school or daycare. So again, they don't want you using PPP money to fund stuff that's effectively eligible for tax credits. So no double dipping. And then on the tax side, on the PPP loan forgiveness, and this is something that I can tell you as a tax accountant, this is going to make our jobs harder come tax time next year. As it stands right now, any loan forgiveness is considered non-taxable income, and this is a great thing that's out there because general rule of thumb is that anytime you have a loan and it's forgiven, it's considered cancellation of debt income. That's taxable income, but this is going to be tax-free income. And again, just to point this out, this is a loan on the books. So when you're doing the accounting for these PPP loans, it's a loan on the books until the bank says it's forgiven. Then it gets converted to income. Now, at the moment, I say at the moment, this could change, but as it stands in present day, you can't deduct any expenses that are funded by loan forgiveness proceeds. So if the loan is forgiven, good news is that the income comes off the tax return. But on the flip side, the expenses that were funded by that PPP loan forgiveness, that also comes out. So if you get 100% loan forgiveness, it's effectively a wash for tax purposes. No income, no expenses on the flip side. Now, what's tricky about this is that we don't know the timing of when the expenses become non-deductible for tax purposes. So what this means is that it's very likely that a lot of these PPP loan forgiveness applications are going to roll into 2021. So if the PPP loan that's on the books, if it's forgiven in 2021 and then it gets converted to income, when do the expenses come off the tax return? Does it happen in 2021 when the loan is forgiven? Does it, become applicable in 2020 retroactively when those expenses were paid for? We don't know. And we imagine we're going to have to get more guidance on this. But this is one thing I think you got to be very cognizant of as you start planning for taxes next year. You start doing some year-end tax planning later in the year. And we'll have to wait and see how this one shakes out. And then the last thing, the PPP loan forgiveness application. There were some changes as a result of this. So the Form 3508, that is the form that is used for the loan forgiveness, it was revised. What they did was they made it a lot more streamlined. It's only 7 pages now. And basically, in addition to making it a lot more shorter, but they took into effect the changes that came from the Paycheck Protection Program Flexibility Act. But what they also offered, this is brand new, is they offered a Form 3508 Easy. And this is a 3-page form which really streamlines going for this loan forgiveness. And you can use the 3508 Easy form if you fall into one of 3 categories. One is you're self-employed and you have no employees. And as we mentioned earlier, if you're self-employed and you go for the 24-week period, you should be able to get 100% loan forgiveness. That's basically going to cut to the chase with this. The second one is you did not reduce any salaries or wages by 25%. You didn't reduce the hours. You didn't reduce your FTE headcount between January 1st and the covered period. So basically, again, if you have nothing to report as far as reductions, you'll fall into that second category. And then the third category is that if you did not reduce your salary or wages by 25% or more, and you're unable to operate during the covered period at the same business level before February 15th due to compliance with health issues, you can do this as well. However, I put an asterisk next to this. We don't know what this means. It's very broad, very vague. I mean, to be honest, anyone can say that they aren't at the same business level because of health requirements. So I would proceed with caution if you fall into that third bucket. I'm almost hesitant to say just go with number 1 or number 2 for the moment if you go with the 3508 Easy. Loan tracking, this did not change. Same, best practices still apply. Keep the PPP loans in a separate bank account so you can track it. And again, you got to track this stuff because, when you go to apply for the loan forgiveness, the bank is going to say, show us what you did with the money during the 8 weeks, the 24-week period. So you'll, be good to have a journal or account ledger handy. And you need to have the appropriate documentation to support receipts, payroll records as an example. And what will lenders need to approve the loan forgiveness? Still relatively the same stuff. FTEs, you need to have documentation to confirm the number of FTEs for any elected period that you have. Even if you go with the 3508 Easy, you need to support that I didn't reduce my FTEs between January 1 and the end of the covered period. They're not going to just take you at your word that I didn't reduce my headcount. They want proof that nothing changed. Payroll costs, same documentation. You're going to need bank statements, payroll tax filings. You're going to need canceled checks to support the health insurance and the retirement plans if you're throwing those into the payroll bucket. Non-payroll costs, you're going to need copies of the loan amortization schedules, the lease agreements, account statements for utilities and mortgages, also canceled checks. So they're looking for proof that this stuff was in existence before February 15th and you actually paid it. And as a borrower, you still got to test that you accurately verified the payments were in fact for forgivable costs. And then our inclusion, to wrap this thing up, you know, the Paycheck Protection, Flexibility Act, as I mentioned, it really changed a lot of things. I mean, again, not a lot of rule changes, but some big game changers as a result of it. And while the good news is that while it brings a lot of flexibility, what it does come with is really a lot of questions and a lot of things that as a business owner, you really got to think through. And so what I'm going to do to conclude this is I'm going to give you some key takeaways and really some questions that you got to ask yourself when you think about this PPP loan forgiveness. And the first question is, do I use an 8-week period or a 24-week period? And I will tell you, there will not be a one size fit all with the 8 or the 24-week period. I'll give you an example. I spoke with a couple of clients yesterday, and while I'm sure most of you are thinking 24 weeks is the way to go. However, I spoke with a food distributor yesterday, and their 8 weeks is up. They spent all the PPP money, and they're still not back up to full force, and they're going to have to start furloughing and laying off some employees. And if, in which case, a 24-week period would not make sense, because if they're close to making the loan forgiveness work with 8 weeks, if they go with the 24-week period, they're going to see a drop off in their FTEs. They're going to see a drop off in maybe some of the salaries or the hourly wages they're paying some people. Just to give you an example. Another question you got to think through: what will be my timeline for putting employees back on payroll and spending the PPP funds? I'll tell you, do not wait till the last minute. You got to really kind of think about a timeline. So if you have people that are laid off or furloughed right now, when are you going to bring them back to make the mechanics work? Or if you need to cut them, as I mentioned with my previous example, what's the appropriate timing for doing that? And will I need that December 31st, 2020 safe harbor date to restore my compensation levels and FTEs? And I'll tell you offhand, I think a lot of people are going to need that, especially if you go with the 24-week period. It may not be a perfect, 100% loan forgiveness. So that is going to be a get out of jail for a lot of people. I will say I did not mention this, but we are still unclear on what does it mean to meet the safe harbor for December 31st. Does it mean just putting people on the payroll roster? Does it mean you put them on the payroll roster and you pay them and you bring them back to a status quo what they were paid? We don't know, and we're gonna have to get more guidance on that. And I imagine that's going to be coming out before the end of the year. And then the big question: when do I apply for the loan forgiveness? And what we've been telling a lot of our clients, you got 10 months from the end of your covered period to apply for this thing. So you have a lot of time to go for it. Unless you're certain at this time that you have an 8-week period, you're close to getting 100% loan forgiveness work. Otherwise, just take your time, wait it out. See if a 24-week period will give you better results. See if you need that December 31st safe harbor to, make things work. Also, I will qualify this. There are rumors floating around that there could be more rule changes. This has already changed a couple of times. There's rumors that the banks, they're going to be inundated with a lot of paperwork with this. They may just forgive these loans if it's under a certain threshold. Not at the moment, but I wouldn't be surprised if that comes out. So again, in addition to kind of see which metrics and what ways make the most sense, there could be more changes that come. And so if you jump the gun in applying for the loan forgiveness, waiting it out might work out better potentially, contingent upon any changes that come as the result of this. So these are very big things you got to think about, and you really got to think this stuff through before you go for the loan forgiveness. And that's really all I have right now. So, this is my contact information if you want to reach out to me with any questions. And with that, I'm going to turn it over to Margie for the Q&A piece.
Aaron, thank you so much. I appreciate this, and we will have you back for sure with any more updates or changes. We have some questions in the chat. One question is, can I apply 1 month of rent to PPP and say 2 months for idle, or can you use only apply rent, one or the other?
That's a very good question. And, and we're waiting on guidance on this, but I'll tell you on the conservative end, what I've been telling clients is it's rent for one, not the other. So, and I've had that question come up was, okay, I do 2 months of rent, I do 2 months of payroll for the PPP, then I switch over to the EIDL. But conservatively, in our belief is it's one or the other with regard to that, because we don't want to put people in a position where, all right, you do 2 months here and then you switch over to the other one, and then that you're set up to fail if the EIDL gets audited later.
Okay, thank you. Another question is, what would be the downside of extending to 24 weeks from 8 weeks?
That's a very good question. I talked about that a little bit. So to give you my example, let's say you take an 8-week business owner, they make everything work, they keep their FTEs at status quo, they don't cut any wages or hourly wages by 25% or greater, and then 8 weeks is up and you're out of money and business is not back to where it was. So like the food distributor that I mentioned, I was talking with a law firm yesterday where they're still, they still don't have the type of business they had previously. So if you go to the 24-week, there's no money to keep people on payroll effectively. And these people I've been talking to, they have to start doing, layoffs and furloughs because there's no more money to pay these people. And that's where the 24-week could work against you. Honestly, I think 24 weeks, what we're finding is for a majority of the people is going to be the way to go, but there are going to be some special circumstances where 8 weeks is going to make more sense.
Another in the chat, self-employed performer. I repeat, which I used to cover gigs that I lost. I thought all my loan would be forgiven. Can you explain the 24-week period again? Also, how do I prove how in the PPP and monies?
I'm sorry, Marge, you can repeat that one more time, please? Yeah.
Okay.
Go ahead and
I'm
repeat
a
it.
self-employed performer. I received a PPP loan, which I used to cover gigs that I lost. I thought all my loan would be. Explain the 24-week period again. Also, how do I prove how I spend the PPP and idle monies?
Sure, absolutely. I'll start with the easy one. With the idle money, the idle may not, it's not going to be under as much scrutiny as the PPP. I've talked with the SBA and they've said with the idols that they could potentially come and look at it. And if they come and look at the idle, then the burden of proof is on you to show, all right, here's this, let's say $100,000 idle loan. What did you do with it? And then you got to show, all right, 20,000 went here, 30,000 went here, et cetera. And then on the PPP money, what they're going to want to see is that, assuming there's, employees, they're going to want to see burden of proof as such as, all right, show us what you did, show us your, employee roster during the 24 weeks, from when this all started, and show us where the money went effectively. That answer the question? Yeah. Okay.
And last question is, what can the idle be used for?
Good question. The idle is, think of it as a working capital loan. That's the nickname for it. And a working capital loan, you can use it, it's basically intended for status quo. And what that means is it's not to be used for expansion. It's not, be able to use to, refinance any existing debts. I've had to tell a couple clients, you can't take the idle loan at 3.75% and take out a loan that's got a higher interest rate. You can use it for, cost of goods sold, accounts payable, maybe some repairs and maintenance, basically routine expenses. The only thing you can't use it for is, refinance, existing loans, expansion, and anything else that's covered under the PPP. So if you have payroll, rent, and utilities under the PPP, conservatively, we're saying you can't turn around and use the idle money for that as well.
Okay, I don't see any other questions in chat. So anyone else, last chance to ask Aaron any questions you might have, or you can check with him directly. He gave you his contact information, or I will send these slides out to everyone that's participating. And I want to thank you all for coming. And if there is any other webinars you would like to know about, let me know and we can set it up. And let's see, Aaron, thank you again so much. And I'm sure we'll be in touch if there are any other changes that we can get everybody updated on. And I want to thank you for your time again.
Absolutely. Thank you for having me. I appreciate it. Thank you.
Okay, everyone, have a great day.